Welcome to this explainer. Look, we are right in the middle of a massive AI bubble, and it's definitely time to cut through all the noise to figure out exactly which financial jobs are going to survive it and, well, which ones won't. If you're tracking the markets, you already know that artificial intelligence is reshaping capital allocation at absolute lightning speed. But we're not here today to just echo the daily panic. We're here to answer a highly focused analytical question: which financial jobs are actually at risk? We're going to unpack the underlying economics of this massive technological shift, completely bypass those vague, terrifying headlines, and look at the concrete realities of your daily work, your career trajectory, and your long-term financial strategy.
Everyone is talking about AI taking over the world, right? I mean, it is the inescapable drumbeat of the market right now. Trillions of dollars in market cap have been added to tech equities in record time, based almost entirely on this premise. Honestly, it feels like every single day a new foundation model drops, and it's accompanied by this wave of articles claiming that algorithms are going to vaporize entire sectors overnight. For professionals in the knowledge economy, and specifically in finance, this creates relentless psychological pressure. It drives a very real fear that years of highly specialized experience might suddenly just be rendered obsolete by a few lines of code. But as we know from decades of market history, panic buying or panic selling based on broad generalized narratives, that's never a sound financial strategy. We have to separate the macroeconomic noise from the microeconomic reality.
So let's take a step back. What does the actual cold logic say about your specific career and your investments? Historically, every major technological bubble, from the dot-com boom to the advent of high-frequency trading, creates a very specific set of winners and losers. To figure out exactly where you stand, you've got to strip away the science fiction scenarios and look purely at the structural economics of the industry. We need to evaluate how this specific technological shift intersects with the ways wealth is actually built, managed, and preserved in the real world. By applying a really logical framework, we can identify exactly where automation is a direct threat and where it's an unprecedented leverage point. Okay, Section 1, the AI bubble. Let's focus on separating the hype from the actual long-term wealth opportunities. So what is the AI bubble? It's basically this wild, highly specific market environment where explosive technological promise is just colliding head-on with a massive influx of capital. Whenever a transformative technology arrives, the market invariably throws money at everything even slightly adjacent to it. Right now, that means massive valuations are being placed on what are essentially AI wrappers, those thin software layers built on top of existing models that offer literally no real defensive moat. That is the hype. But buried beneath all that froth are the actual structural wealth opportunities. We're talking about the infrastructure layer, semiconductor designers, advanced data center real estate, and the energy grids required to power all this next-generation computing. As an investor or professional navigating this, it requires rigorous fundamental analysis. You've got to actively filter out those consumer-facing parlor tricks and focus on the companies using AI to fundamentally expand their margins, drive operational efficiency, and capture permanent market share.
The cognitive shift required from us here is massive. The hype narrative is broad, it's unfocused, and it relies on this vague idea of a total machine takeover. Honestly, it's fundamentally unactionable. You can't build a durable career strategy or construct a resilient portfolio based on the fear that robots are coming for everything. The real power lies in the logic. Logic dictates a surgical approach. It requires investors to stop blindly buying tech stocks just because they have .ai in their domain name and instead start analyzing exactly how corporate efficiency is actually being redefined. For your career, it means breaking down your specific financial role into its component tasks, figuring out which of those tasks are easily predictable, and pinpointing where your human insight is entirely irreplaceable. Shifting from panic to this kind of structured, logical analysis is for sure the only way to capitalize on the current market dynamics.
Let's move into our next core area: financial jobs at risk and the true economic impact of automation. Now, this is where the rubber really meets the road. When we analyze specific careers right alongside investments, a dual economic impact emerges. On the career front, the direct result is workforce automation. Let's be totally concrete about this. If your job relies on basic compliance checking, level 1 risk assessment, or standard data entry and formatting, those roles are directly in the crosshairs. The junior analyst spending 8 hours a day scraping financial statements to update standard valuation models, they are facing intense automation pressure. But flip the perspective over to the investment side, and that exact same automation translates into massive long-term wealth opportunities. Private equity firms leveraging AI for rapid due diligence, or huge asset managers building proprietary data lakes to find alpha in unstructured data, they are creating immense value.
The technology hollowing out the bottom of the labor market is simultaneously generating unprecedented operating leverage for the firms that deploy it correctly. Understanding both sides of this equation is absolutely crucial to positioning yourself defensively in your career and offensively in your portfolio.
So the true economic impact on the workforce is best understood as a hollowing out of routine cognitive labor. Think about it. A junior investment banking analyst tasked with building a complex discounted cash flow model. A few years ago, that was a highly specialized skill. It took a weekend of grueling Excel work. Today, an AI model can instantly synthesize the historical data, apply the growth assumptions, and output a structurally sound DCF in seconds. The automated generation of that model is simply no longer a high-value skill. However, and this is key, taking that instant model into a boardroom and using it to counsel an anxious CEO through a delicate, high-stakes merger negotiation, that requires empathy. It requires nuance and human trust. Algorithms do not build trust. The economic impact forces a severe polarization. It brutally devalues the mechanical generation of data while placing an absolute premium on human judgment, strategic foresight, and complex relationship management.
Let's pivot to the actionable phase of our explainer. It's time to talk about AI-proofing human capital and securing your workforce value. To truly secure your position in an automated economy, you've got to systematically execute this three-step framework. First, analyze the AI bubble and recognize the macroeconomic reality you're operating in. Second, separate the hype from the true wealth opportunities by focusing on structural efficiency gains rather than those flashy headlines. But the third step, AI-proofing your human capital, is without a doubt the most critical. What does that actually mean for you as a financial professional? It means pivoting from quantitative crunching to qualitative insight. You must transition from being the writer of the analysis to the editor of the AI's output. It means mastering prompt engineering to direct bespoke financial models, rather than building them entirely from scratch. It means leaning heavily into the interpretation of idiosyncratic risks, things like sudden geopolitical shifts or regulatory changes, that algorithms trained on historical data inherently struggled to predict. If AI is going to handle the math, your human capital must be entirely concentrated on the strategy, the client relationships, and the high-level decision-making. You've got to consciously develop those skills that are insulated from computational brute force.
So, I'll leave you with this. Are you caught up in the hype of the AI bubble, or are you actively AI-proofing your human capital? It's so easy to be paralyzed by the headlines and just wait to see what happens to your industry. But think of AI kind of like the introduction of Excel to the accounting industry decades ago. Excel didn't replace accountants. It just eliminated the ones who flat out refused to use it, while making the adaptable ones exponentially faster and more valuable. AI is the exact same dynamic, just on a much, much larger scale. By utilizing the logic we've walked through today, analyzing the specific vulnerabilities in your sector, and aggressively elevating your qualitative strategic skills, you can totally ride this wave instead of being crushed by it. Thank you so much for joining me for this explainer. Start auditing your daily tasks, start directing the algorithms, and take control of your human capital today.